Hello everyone. Welcome to our final financial reporting update for 2019. We expect today's webinar to take approximately 45 minutes. My name is Elisa Noble and I'm joined today by Jonathan Compton. We're both from BDO's Technical Financial Reporting team. The focus today is on reminders for the next reporting season. So on the agenda today, firstly, as year-end reminders, we'll provide a very brief overview of the key new financial and narrative reporting requirements relevant for this reporting season. We will focus on IFRS and narrative reporting requirements for UK companies. UK GAAP is not on the agenda today, as we've covered in previous webinars the triennial amendments to FRS 102, which are now effective. Secondly, we will look at various publications issued by the Financial Reporting Council, the FRC. There are usually a number of important action points to take away from these publications, which this year include the annual review of corporate reporting, several thematic reviews, and FRC lab reports. The FRC's monitoring and other review work is usually focused around areas where they regularly find errors and non-compliance, also new reporting requirements and matters of topical relevance such as Brexit and climate change. So it's well worth understanding what they have to say on these areas. Thirdly, as many of you are preparing to report for the first time under IFRS 16, the new standard on leases, we will explain the key disclosure requirements and what the FRC is expecting to see in annual reports. Finally, we will summarize a few areas to focus on in the next reporting season and highlight some new reference materials. So, starting with the year-end reminders, let's begin with a reminder of the main IFRS changes that are newly effective for periods beginning on or after 1st of January 2019. The most significant change for most IFRS reporters is IFRS 16, the new standard on leases. We have been talking about IFRS 16 a lot in this year's webinars, and today we will be explaining the disclosure requirements in a little while. Out of the other changes, IFRIC 23 on uncertain tax treatments is also potentially significant for some companies. We looked at IFRIC 23 and some of the other changes in our June webinar earlier this year, and you will find information on all of these changes in BDO publications available on our website. Okay, next on this slide, we have the standards and amendments which are issued but not yet effective. These are the ones which you may need to disclose in this year's financial statements, or perhaps consider early adopting, subject to EU endorsement. IFRS 17 is of course a significant change for affected entities, and this will take some time to be endorsed, so this is not yet available for early adoption. For any companies that hedge account for interest rate swaps referencing LIBOR, we do recommend early adoption of the amendments to IAS 39 and IFRS 9, subject to EU endorsement. Equivalent amendments to FRS 102 are also now available and effective. Some entities with business combinations in the year may also be interested in early adopting the amendments to IFRS 3. Note that EU endorsement is still outstanding for all of the amendments on the screen, but we do expect that before the end of the year and their effective date, or in the case of the last amendment relating to IBOR reform, by the end of January 2020. So what that means is that these amendments will be available to EU IFRS adopters for their December 2019 accounts, as long as those accounts are signed off after EU endorsement is received. If there is any further delay to endorsement and Brexit takes place before then this could complicate matters. Right, next, the other area where there are a lot of changes is in relation to large company narrative reporting. Now, we have been talking about these changes in previous webinars, but we thought it would be a good idea to summarize the new requirements. So on this page are 4 changes effective for all large companies, referring to Companies Act large size criteria, and applicable to both parents and subsidiaries. So 4 new requirements applicable for periods beginning on or after 1st of January 2019. Some of these requirements have further more specific scoping criteria or limits, but let's begin with the Section 172 statement. So the Section 172 statement is a new requirement to explain how the directors have had regard to wider stakeholder needs when performing their duties under Section 172 of the Companies Act. This statement should be a separately identifiable statement within the strategic report and should also be published on the company's website. BDO has recently published guidance which aims to help preparers in drafting the Section 172 statement. The second requirement is for large companies with more than 250 UK employees to provide a statement summarising how the directors have engaged with employees. The third requirement is similarly for all large companies to provide a statement summarising how the directors have had regard to the need to foster the company's business relationships with suppliers, customers, and others. So both of these statements are to be included in the directors' report and should explain how the directors have had regard to these matters and the effect of this regard, including the effect on principal decisions taken during the year. The final requirement, final of the 4 requirements, is for unquoted large companies who have more than 2,000 employees and or meet the financial thresholds on the screen. That's the ones under the blue box. So these very large companies will need to include a statement of corporate governance arrangements in the annual report and on their website. And this is where the weights principles on corporate governance may be helpful in meeting this requirement. A little bit later, for periods beginning on or after April 2019, there are new energy and carbon reporting requirements which will apply to all large companies and LLPs. So those with a 31st March 2020 year end will be among the first to report. These requirements enhance and extend the greenhouse gas reporting requirements, which are applicable so far only to quoted companies. So what this involves is that those consuming more than 40,000 kilowatt hours of energy annually will need to provide a number of disclosures. There are some exemptions for subsidiary companies and some differences in quoted and unquoted company requirements. On the topic of quoted companies, there are a few more narrative reporting changes affecting them. So firstly, 2 changes to directors' remuneration reporting. The first one, the CEO pay ratio, is applicable to quoted companies with more than 250 UK group employees. And this requires a comparison between the single total figure of remuneration of the CEO against amounts that represent the 75th, 50th, and 25th percentiles of full-time UK employee pay bands, with also some disclosure about the methodology to calculate these amounts. The next one is a disclosure about share price changes applicable to quoted companies, and this is where you need to provide an analysis of how the remuneration paid and payable to directors may be affected by growth in the entity's share price. So thirdly, for quoted companies, in particular premium listed companies, the 2018 version of the UK Corporate Governance Code is now applicable, and there have been a number of changes there which may well result in changes to the annual report disclosures. Finally, quoted companies and now also traded companies should also bear in mind yet more changes to directors' remuneration policy and reporting requirements resulting from regulations in 2019, which are effective from 10th of June 2019. Some of those changes apply to any policies being presented for shareholder approval since 10th of June 2019, And we understand many premium listed companies may be wanting to early adopt some of these disclosures. So that's a summary of what's effective in this reporting season. And after that overview, Jonathan will now continue with some of the recent communications from the FRC.
Thanks, Elisa. As usual at this time of year, the FRC has been busy releasing publications documenting the findings from its work. The main publication is the Annual Review of Corporate Reporting, which is an overview of all of the FRC's Corporate Reporting Review Team's activity over the last year. The content is based on the general monitoring work of the CRRT, sometimes more commonly referred to as the FRRP, but it also refers to the findings from its specific thematic reviews conducted during the year, as well as other topical areas of focus and outreach, such as the work of the FRC's Financial Reporting Lab. At the same time as publishing its annual review, the FRC also wrote an open letter to audit committee chairs and finance directors, which effectively acts as an executive summary for the annual review and highlights key improvements expected in the upcoming reporting season. Together, these two publications place particular emphasis on recent changes to reporting requirements and the need to address broader matters of concern to investors and other important stakeholders, such as non-financial risks. Finally, the FRC has also published 4 separate documents detailing its findings from the main thematic reviews conducted during the year on the impairment of non-financial assets, the quality of disclosures on IFRS 9 and IFRS 15 in the first year of their implementation, and the quality of disclosures on IFRS 16 in interim reports in the first year of implementation. I'm going to look at the annual review and 3 of the thematic reviews in a little more detail before handing you over to Elisa, who will look at IFRS 16. Turning first to the annual review of corporate reporting, one of the key messages from the FRC this year was that it expects companies to improve the quality of reporting on forward-looking information, including reporting on emerging risks, the carrying value of assets, and the recognition of liabilities. The FRC emphasises the importance of trust in business and that, in times of uncertainty, users expect greater transparency in these areas. That rule of thumb would be a good thing to bear in mind when drafting any annual report disclosures over the coming months. The other consistent theme running throughout the annual review was one of continuous improvement. This was reflected in many of the key messages in the annual review and the thematics, where the FRC often cited improved practice compared to previous years, but still highlighted room for further improvement. As you can see from the categories on the screen, the FRC has continued to raise questions in many of the same areas as it has in previous years. It should be noted, however, that for many of these areas, the questions raised in previous years were of a much broader nature, whereas, as general practice has improved, this year the FRC has been focusing on more specific aspects of the relevant disclosure requirements. Over the next few slides, I will highlight some of the FRC's key findings. However, the annual review is one publication that we really do recommend that you pick up and read fully. It's reasonably digestible and contains some useful examples of good practice. Moving on to the detail, the FRC is continuing to pay particular attention to judgments and estimates disclosures, an area it has reported on in previous annual reports. It sees these disclosures as being particularly important for investors as they highlight the parts of the financial statements most susceptible to changes in future periods and areas where alternative treatments might have had a particularly significant effect on the numbers presented. Whilst in previous years the FRC's finding was that the general application of these requirements was quite poor, this year the challenge has been more nuanced. The FRC sought better articulation of the key estimates and judgments in the disclosures, with a view to seeing how they could best inform investors. Improvements were called on in terms of quantification, for example, the reporting of sensitivities or ranges of reasonably possible outcomes. The FRC observed that companies tended to omit the IAS1 estimates and judgments disclosure information unless it was also required by another more specific standard. For key judgments, the FRC is looking for information about the consequences of an accounting judgment and what the alternative treatment might have been, rather than just indicating the existence of that judgment. Cash flow statements was another area where the FRC continued to find errors. It raised an overriding concern that the errors were often easy to spot from a desktop review, which the FRC considered to be an indication of an issue with quality control procedures around the preparation of annual reports. Basic errors noted in the annual review included the misclassifications of items within operating, investing, and financing cash flows. It identified errors with reconciling items and expressed some concern that the IAS 7 paragraph 44 disclosure, the disclosure of changes in liabilities arising from financing activities, was in some cases incomplete, for example, omitting lease liabilities. The recently released Financial Reporting Lab report on the disclosure of sources and uses of cash sought to understand what information on this subject, other than the basic cash flows, investors wanted from the annual report. 2 levels of improvement were identified, depending on whether or not the availability of cash was a significant issue for the company. Where cash resources were not a significant issue, investors wanted to see more joined-up, holistic disclosure across the annual report and other investor communications. This could include discussion of priorities for the use of cash, analysis using KPIs, a specific focus on cash in business model disclosures, and so on. For companies that are experiencing more significant challenges relating to or affecting cash, improvements could include more transparent disclosure of significant working capital arrangements and more disclosure on restrictions and risks that could affect cash and its use. This desire for more forward-looking information, however, did not detract from the importance of the cash flow statement itself. Investors still see this as a very important primary statement. The FRC also repeated its previous call for more transparency over the use of reverse factoring or supplier financing arrangements. It highlighted a number of disclosures that it would expect to see in this regard. It is very likely that it will continue to challenge companies where it thinks such facilities might not be adequately disclosed. In the front end of the annual report, the FRC continued to identify strategic reports that it did not consider were a fair, balanced and comprehensive review of the development, performance and position of the business. The FRC challenged all good news narrative where greater balance was considered more appropriate, and the completeness of principal risks, in particular key environmental risks. More specific observations included companies not adequately explaining in the strategic report significant balances, transactions, or other changes evident in the financial statements. Examples include business reviews that fail to discuss the performance of significant acquisitions, the progress of transformation programs, or major changes in or concentrations of credit risk. The FRC highlighted that, in addition to the disclosure of performance, which most companies do provide, particularly at a revenue and gross profit level, developments in the company's financial position and cash flows should also be discussed with due prominence and emphasis. Whilst there was an improvement in the use and disclosure of alternative performance measures, or APMs, the FRC still observed companies omitting or giving unclear definitions and/or reconciliations. It repeated its recommendation that all companies reporting APMs should follow the ESMA guidelines on the subject. It also said it will continue to challenge companies that continue to exclude non-recurring items year on year without an adequate explanation as to why, especially where those non-recurring items appear to be similar in nature each year. For provisions, the FRC challenged overly aggregated reconciliations, missing or inadequate descriptions of uncertainties, disclosures that were inconsistent with information elsewhere in the annual report, and insufficient quantification of contingent liabilities. Non-financial risks, or environmental, social and governance, or ESG issues, are becoming ever more important to investors and other stakeholders. Actions taken against carbon-intensive business activities by governments and consumers can have a profound effect on the prospects of those businesses over the short and medium term. The same is true for the other issues falling under the ESG banner. Consequently, regulators and investors are giving increasing attention to the related disclosures. In the annual review, the FRC highlights that where a large public interest entity company is required to prepare a non-financial information statement under Section 414CA of the Companies Act, it needs to be a separately identifiable section of the strategic report. even if that section simply comprises a series of specific cross-references to elsewhere in the annual report. Not only is this a requirement of the law, it also enables investors to locate information that can sometimes be widely dispersed over many pages of narrative. The FRC is also clear that disclosures within the NFR statement or referenced from it should be company-specific and clear. The FRC also highlights that whilst the NFR statement and the new Section 172 statement requirements do not specifically require companies to disclose the potential direct or indirect effects of climate change on their operations and decisions, these should be considered for inclusion in the emerging risk disclosures under the UK Corporate Governance Code and potentially in the principal risks disclosures in the strategic report. The FRC's Financial Reporting Lab has issued a report on climate-related corporate reporting, which includes some useful prompts for board discussions. This report preempts the potential introduction into company law of further ESG-related disclosure requirements for larger companies, which could be based on the Task Force on Climate-Related Financial Disclosure, or TCFD, framework. Of course, no self-respecting corporate reporting webinar can forego a mention of Brexit, and so we come to it here. In this case, the FRC observed an improvement in disclosures, perhaps from a low base, with most companies mentioning Brexit in their narrative reporting, and many including it within their principal risks disclosures. The annual review summarises the types of risks that were most often mentioned, which were very varied as one might expect, depending on the industry within which the company operated. The FRC also encouraged companies to consider Brexit within the viability statement where applicable. On topical issues in general, such as Brexit, climate change and cybersecurity, the FRC warned against using bland boilerplate statements. Instead, it favoured more specific, tailored information about how they might affect the company specifically. Of course, in rapidly changing topic areas like Brexit, care needs to be taken that the disclosures are as up-to-date as possible at the date of approval of the annual report. Moving on to the thematic review reports, I will in a moment take a brief look at the FRC's finding in respect of the disclosures on IFRS 15 and IFRS 9 in their first year of the standards adoption, before Elisa moves on to IFRS 16. Firstly, though, I'll take a look at the thematic review on the impairment of non-financial assets. As a general remark, before we delve into the detail, the FRC's thematic review reports are very useful publications. Like with the annual review on corporate reporting, we strongly recommend that you take a look at these reports for yourself if they relate to matters that are material to your financial statements. Like with all of the FRC's more recent thematic reviews, these latest reports provide many practical examples and illustrations of good practice, alongside highlighted areas for improvement. The FRC decided to perform a thematic review on the impairment of non-financial assets because it's been a frequent area of challenge in its routine monitoring activities. The subject is also of greater relevance in times of economic uncertainty, so the current backdrop of Brexit and the struggling UK high street means that it is at the forefront of the FRC's mind at the moment. The FRC's sample consisted of 20 FTSE 350 companies, with a focus on those operating in the retail and business services sectors. Broadly speaking, it found a good deal of good practice, but rarely, if ever, was that good practice evident across all aspects of a single company's disclosures. The report also touches on specific topic areas, such as Brexit uncertainty and its effect on key assumptions like growth and discount rates, climate change and other environmental factors, and how, in particular, they might indirectly affect operations through government and consumer actions, and the need for underlying impairment models to change as a result of the adoption of IFRS 16 and the introduction of right-of-use assets into CGUs. In terms of disclosure, the thematic review highlights good and bad practice under three broad headings: assets and CGUs subject to impairment, key assumptions, and sensitivity analysis. In the first category, better disclosures described how the company identified single sites or clusters of sites as CGUs, and how CGUs were grouped together for the purposes of testing goodwill for impairment. They also gave clear explanation of the triggers for any impairments. However, at a more detailed level, some companies omitted the recoverable amount of the assets and CGUs subject to an impairment loss or reversal in the year. For key assumptions, better disclosures identified and quantified estimates used in budgeted cash flow projections for each material CGU or group of CGU. Not just the long-term growth rates used to extrapolate the budgets and discount rates applied to the cash flows. They explained how management determined the actual values used, linking these future expectations to external conditions and/or the company's own strategy. Better disclosures also explained clearly how the discount rate had been derived, differentiating between CGUs with different risk profiles. For sensitivity analysis, some companies omitted the values for key assumptions that would lead to headroom on goodwill reducing to zero, which is a required where it's considered to be a reasonably possible change. The amount of headroom that the current impairment test has indicated is also required in these circumstances. The better disclosures also clearly stated that the changes in key assumptions management think to be reasonably possible and the effects of those changes. Poorer examples stated that headroom was sensitive to changes in key assumptions, but gave the effect of apparently arbitrary changes to those assumptions of, say, plus or minus 1%, rather than more meaningful changes. The FRC indicated that companies should distinguish more clearly between matters of significant judgment, for example, the determination of CGUs or groups of CGUs, and estimation uncertainty, for example, future cash flows and discount rates. Finally, the FRC indicated that it often challenges company-level investments in subsidiaries where they exceeded market capitalisation. The IFRS 15 thematic review followed up on the FRC's thematic review of IFRS 15 in interim accounts by looking at 25 companies in sectors the FRC thought would be most affected by the standard. The main issues identified were that there is scope for improved accounting policies and, in particular, the specific nature of performance obligations and when they are satisfied, including whether a company is acting as principal or agent and how that judgment has been reached. The revenue streams identified in the policies, the information included in the segmental reporting note, and the narrative in the strategic report was sometimes inconsistent or the link unclear. Information about significant judgments often appeared to list all judgments involved in the accounting for revenue, rather than identifying and explaining only those that had a significant effect on the amount and timing of revenue recognition. Descriptions often lacked clarity about the specific judgments made, and numerical disclosures such as sensitivity or ranges of reasonably possible outcomes were often not provided for estimation uncertainty. The FRC highlighted an improvement in balance sheet related disclosures since studying the effect of the adoption of IFRS 15 in interim accounts. However, some companies made no reference to cost to obtain or cost to fulfill a contract, which in some instances was considered surprising given the nature of the company's activities. Finally, for me, the IFRS 9 thematic review, which also followed up on the FRC's review of interim accounts last year, looked at 20 companies, including 10 companies operating outside of the financial services sector. The main issues identified for non-financial services companies were, under classification and measurement, poor explanations of the business model under which the financial assets are held. Whilst this might normally be expected to be held to collect, confirmation of this was encouraged. The FRC identified instances where companies provided accounting policies that were untailored. Including policy statements for instruments that are not held by a company create unnecessary clutter and complication. The FRC also noted some companies simply had not updated old IAS 39 policies. For impairment, IFRS 7 requires a company to disclose the gross carrying amount of financial assets by grade of credit risk rating. For trade receivables, contract assets and lease receivables, this may be based on a provision matrix. These disclosures were not well presented in the FRC's sample. The FRC also identified one instance where a company held material IFRS 15 contract assets, but did not appear to apply the IFRS 9 impairment requirements to them, despite contract assets being within their scope. Referring back to policies once again, IAS 39 language sometimes had not been updated, and there are a few instances where IAS 1 significant estimates and disclosures were evident. The one overriding theme throughout all three of these thematic reviews is one of a greater need for tailoring of information so that it is both company-specific and relevant to investor needs. I'm now going to hand you over to Elisa, who will take a look at IFRS 16.
Thank you, Jonathan. The disclosure changes resulting from IFRS 16 are quite extensive, and it may take some time and resources to actually prepare these disclosures in the first year of adoption, so do think about starting early on those. A number of different parts of the annual report will be affected. So this includes each of the primary statements. The income statement, balance sheet, and cash flow statement is likely to be affected by at least some presentation changes. The extent of changes, for example, in the balance sheet will depend on the transition method and also the presentation choices available to companies to either include right-of-use assets and lease liabilities as separate line items or together with other related assets and liabilities. All entities will need to include a note explaining the effect of adopting IFRS 16 and the transition approach used, especially under the modified retrospective method. Specific transitional disclosures are required. Companies will need to update their lease accounting policies, including significant judgments and estimates, which we've just been talking about in terms of the FRC's comments. And there are also various specific disclosures required by IFRS 16 on an ongoing basis, which we'll look at in a moment. Finally, front-end reporting also needs to be considered. Set out on the screen now is a summary of some of the expanded disclosure requirements introduced by IFRS 16. So with most leases for lessees now on balance sheet, IFRS 16 includes specific disclosure requirements in relation to right-of-use assets and lease liabilities, including carrying amounts, a maturity analysis of lease liabilities, as well as information about some of the movements in those amounts, such as additions, depreciation, and the interest expense. Some of the information is to be provided by class of assets. It's worth noting that there are also new disclosure requirements in respect of leases which are not accounted for on balance sheet, on cash flows and future cash flows not reflected in lease liabilities, as well as information about any restrictions or covenants imposed by leases. Entities have some flexibility to choose how to present these disclosures, and this may depend on, again, whether right-of-use assets and lease liabilities are presented separately in the balance sheet or as part of fixed assets and borrowings. For some of the disclosures, the standard does set an expectation, though, for tabular presentation in a single location rather than disclosures scattered throughout the financial statements. One way to consider disclosing some of these specific amounts would be in the form of a reconciliation of right-of-use assets and lease liabilities. The alternative being perhaps some sort of tables where the individual amounts of changes and movements and carrying amounts are given. So this type of reconciliation could be useful to users in giving a picture of what's giving rise to the changes in these carrying amounts during the year, and would also help with cross-referencing to other parts of the financial statements. So, for example, for right-of-use assets, this would tie into the balance sheet, and the interest expense on lease liabilities would tie into the finance expense note. Providing disclosures in the form of reconciliation, which you may have noted from the example on the screen, does also, in many cases, mean giving information about lease modifications, adjustments to revising variable lease payments, if you've got ones linked to an index or a rate, and foreign exchange movements. These are not specifically required disclosures, but may be useful information to disclose or possibly required if they are very significant in a particular year. So there's an example on screen. That's something to consider. Other presentation options could be possible too. Now, on transition, so our first year of IFRS 16 adoption, there are some specific transition disclosures to be provided. And now, in particular, for companies using the modified retrospective approach, which in our experience seems to be the most popular choice, it's important to provide very clear disclosures about the practical expedients applied, because there are a number of practical expedients available in the standard. There are also two specific disclosure requirements for the discount rate, and this is the incremental borrowing rate at the date of initial adoption that is mandated for this method, as well as a reconciliation between operating lease commitments disclosed under IAS 17 and lease liabilities recognized under IFRS 16 at the date of initial application. There's an example of this type of reconciliation on the screen, and you will note that some of the reconciling line items would include, for example, the effects of, firstly, short-term and low-value leases not included in the lease liability under IFRS 16 if the exemption is taken, whereby these can be instead expensed. Secondly, if you've got some extension option periods in your leases which are reasonably certain to be exercised, then these are included in the lease term under IFRS 16 and therefore in the lease liability, but would not previously have been included in minimum lease payment disclosures. And thirdly, of course, the effects of discounting. The lease commitment note was not a discounted figure, whereas the lease liability is a discounted figure. So this reconciliation is a key disclosure, and it can in some cases be a little bit complex to prepare if there are a lot of adjustments. Regardless of the method of transition, so also applicable to fully retrospective adopters, all entities will need to disclose any significant judgments and estimates arising from IFRS 16, and we would expect there to be some. For example, in relation to applying the definition of a lease to identify leases, discount rates, or the lease term. Okay, now, in addition to the other thematic reviews Jonathan talked about, the FRC carried out a thematic review on disclosures about IFRS 16, included in June 2019 interim reports of a sample of companies. So the FRC selected a sample from industries where the new standard was expected to have a significant effect, and targeted companies with larger operating lease commitments disclosed under IAS 17. So the purpose of this review was to observe some of the initial applications, to identify good examples, any weaknesses within those interim disclosures, and therefore it helped the FRC provide a bit of guidance at this time of the year for companies to consider when preparing their year-end accounts. So would recommend taking a look at this thematic review. It will also inform the FRC's selection of annual reports for review during 2020. And basically, they identified some good examples of disclosures and also some weaknesses. So we've got a summary of those on the next slide here. So a number of companies identified key judgments associated with IFRS 16, for example, relating to lease extension options. But the problem the FRC noted was that some companies didn't clearly describe the judgment that had been made. And so the FRC expects companies to describe exactly what the specific judgment made is, and where those judgments involve estimation uncertainty, to also remember to provide those IAS 1 disclosures required. All companies in their sample did clearly communicate the balance sheet effect of adopting the new standard, the assets and liabilities required, but they noted less consistency in clearly communicating the profit or loss effects of transition. Most companies in the FRC sample had used the modified retrospective approach, and they therefore did provide the required reconciliation. between those operating lease commitments, which we just looked at just now. However, some companies did not explain properly what all of the significant reconciling items were, including contracts falling perhaps outside the scope of IFRS 16 and the effect of significant lease extension options. Where such items would be expected to give rise to significant judgments, the FRC expects these to be disclosed. But so far this was not quite the case in all of the interim reports. Companies generally provided good disclosure of practical expedience, but the FRC is reminding companies to ensure that you distinguish clearly between practical expedience on transition and ongoing accounting policy choices. So, for example, in the case of short-term leases, there is a difference there. Only a minority of companies included in their interim reports the full range of new disclosures required by IFRS 16, some of which we looked at just now, with very few adopting the tabular presentation recommended for the provision of this information. Companies that use the modified retrospective approach will be reporting results under IFRS 16 in the current period and IAS 17 in the prior period. These companies will need to take care with the discussion in their front-end narrative reports to ensure that the lack of comparability year on year is explained. Many companies have included APMs to address the adoption of IFRS 16, and it's worth remembering that any such APMs should comply with ESMA's guidelines on this matter. That brings us to the end of IFRS 16 disclosures and communications from the FRC. So just a few closing remarks then. This year, the FRC has not yet formally announced their areas of focus or any topics for thematic reviews for the next year. However, based on the matters addressed by the FRC in the annual review, which Jonathan talked about, and also what is otherwise topical, we have set out on this slide some of the matters we would expect companies to focus on when preparing their annual reports in the next reporting season. And we think the FRC will be taking an interest in these areas too. So this includes strategic reports and narrative reporting, including ESG-related reporting, alongside continuing to monitor IFRS 16 and the reporting of cash. Finally, just wanted to bring to your attention reference materials. We have a number of new and updated BDO IFRS publications to bring to your attention. So the IFRS in Practice series is a series of detailed publications, and there's a newly revised one of those for IFRS 16, which you'll probably find very useful. The illustrative IFRS financial statements for our 31st December 2019 year-end are now available and do include disclosures on both IFRS 16 and IFRS 23. We also have a guide to help you with how to go about preparing the Section 172 statements. All of these publications are available from the BDO UK website, where you'll also find a new IFRS hub to explore. Finally, the BDO Global website also has an IFRS microsite with some of these publications just mentioned and some others. And as a new feature we wanted to highlight is that we have there a collection of online training modules, including e-learning modules and videos to watch on, for example, IFRS 9, 15 and 16. So that brings us to the end of our update today. We do hope you found it useful. Have a good Christmas and do join us again next year.